Welcome to Lesson 6, Part A. We are going to explore the trading-specific performance metrics. Let's define some terminology. Some of these terms have already been dealt with in Lesson 1. We denoted with T the number of trades generated by the trading system. With exp, we mean the expectancy, or the expected value. That is the return of our trades on average, of course measured in basis points. That is the core performance metric of our trading system. With TA, we mean the so-called trading advantage. It tells us how many times the trades are winning compared to the times they are losing. It is the difference between the winning trade percentage and the losing trade percentage. The goal is to have a positive trading advantage. Then the payoff is a ratio which measures the average winning return with respect to the average losing return. The goal here is to have a ratio bigger than 1, which means average win bigger than the average loss. A positive expectancy, which is our goal, stems either from a positive trading advantage or from a payoff bigger than 1. At last we have the profit factor. This is the ratio of the total profits to the total losses, the latter in absolute value. Real-life trading systems are good if their profit factor is bigger than 1.60. If their profit factor is something around 2, they are extremely good. Profit factor estimates above 2, or let's say above 2.50, are a bit unrealistic, and they are usually the byproduct of a faulty assessment practice. The terminal wealth relative is the ratio of the final equity to the initial equity. If we have a terminal wealth relative of 1.50, it means that our equity at the end of the backtesting period is 50% bigger than it was at inception. Thus, we have achieved a 50% return. The maximum historical drawdown, MHD, is an estimate of the biggest temporary loss measured with respect to the last upper peak of the equity curve. The single biggest loss, SBL, is the maximum loss recorded on a single trade. The size is the position size measured as the ratio of the notional value to the equity value, the equity at inception. Please note that we do not go for underfunding here. Feasible underfunding schemes will be tackled just in Lesson 9. At last, we have the netting factors discussed in Lesson 5. These are multiplication factors to be applied to the gross performance figures in order to turn them into net figures, accounting for the transaction costs and the time decay when applicable. Now, let's focus on the drawdown. We have the equity curve plotted here as a blue line on the top chart. That's a satisfactory equity curve, as the equity plotted on the y-axis grows over time. Well, even though at the end of the whole observation period we carry a profit, which is a positive return, we go through partial negative returns, represented by the red plot on the bottom chart. This bottom chart is referred to as the underwater curve. The y-axis of this underwater curve represents losses, then negative returns, expressed in percentage. This percentage is expressed with respect to the last maximum of the equity curve. That is the equity value that we got before we started losing money. The drawdown ends when we recover losses and we get back to the equity value above mentioned. Sometime later, we go through another drawdown that is bigger than the former. This drawdown value reads minus 15%, and that's the biggest drawdown within our observation period. It will be referred to as the maximum historical drawdown. That can be regarded as a risk metric of our trading system. Said risk metric is complemented by the maximum drawdown period. That measures how long it took to recover losses in the worst case. Please note that both the maximum drawdown and the maximum drawdown period are historical estimates. They are just the maximum values recorded within our observation period. More refined risk metrics will be addressed in Lesson 8 and Lesson 9. Well, let's make a real-life example. Let's assume that we hold a long position on the US stock index for as long as 12 years, starting from 2008. Remark that this has nothing to do with MASASP trading systems. It is just for didactic purposes. Such a long position records its maximum drawdown in 2008, the year of the global financial crisis, and then some further moderate drawdowns in the following years. This chart refers to the typical drawdown calculation method, which complies with the drawdown definition provided so far. This drawdown calculation method, though, may be a bit faulty if referred to quite a long observation period, and that is definitely the case. Let's see what happens, in fact, at the middle of this observation period. The drawdown shown here is a percentage calculated with respect to the last equity peak. But at this time, the equity has grown, and it is the double of its value at inception. That will definitely underestimate the amount of this partial loss. We have a sort of shrinking effect. Nonetheless, we can change our calculation method and assume that the invested amount grows year by year as the equity keeps growing across time thanks to the accumulated profits. We will get as a result a drawdown twice as big as the previous one. The profits generated at the end of year are accumulated, and the next year the equity available for investment gets higher. This practice is called compounding. This alternative calculation method, which delivers a penalized estimate of the drawdown, is called the compounding underwater curve. It is not said that one calculation method is better than the other. They complement each other in order to provide a wider analysis perspective as far as the historical drawdown is concerned. Well, that's all for the time being. Thanks for watching, and see you at Lesson 6, Part B.